Hi there, welcome to Kneppy Invest. Another week come and gone. And what a brilliant end to the week it was. The XGO up big. In fact, the Australian market up big. The last three trading days, the XGO up about 1% each day. Now, just because a nice little rally in the last 3 days of the trading week doesn't mean this is the end of the potential bear market or anything like that. This is not the start of a bull market, because when you do have a look at the chart for the XGO, it's just a nice little rally into a resistance area. And that resistance area is the moving average ribbon I have here, which is the short-term moving average ribbon. The last time the XGO moved into that ribbon was back in the middle of October, and then it pulled back again. So who knows what's going to happen in the next few days? This could be it for the SGO. It all depends on what's going to happen on the overseas markets, particularly the American markets. Now, I am confident that maybe there's one or two more days the SGO might rally. I am confident about that, but longer term, maybe I should say medium term, I don't know. I have no idea if we're going to have a Santa rally, even though the experts say, or fairly confident, quite a few are fairly confident, we'll have a Santa rally. There are some years where we don't have a Santa rally, some years where we do. I don't believe in all that crap. I don't believe in those sayings, sell in May, go away, or Santa rallies. I just think it's a load of nonsense. I wonder if anyone's done research on that. Anyway, probably someone has done research on it, and there's probably a little bit of truth to it, but there are some years where the market goes down significantly in November, December. Some years it goes up. Anyway, so it was good to have this nice little rally in the market in the last 3 days, and this could be just a bit of a dead cat bounce. And to take advantage of this little rally, I actually did sell out of two of my positions. Now, saying that, I actually did buy into two companies. So net, I have the same amount of companies in my portfolio, but I did want to take advantage of, not take advantage, but I want to adhere to some rules I'm developing, some investing rules or an investing checklist that I'm developing. And that's why I sold both of those companies. I'll talk about that in my Sunday video. Now, the whole point of me doing this video today is focus on companies that released interesting announcements through the week. I've got about 25 companies I want to look at. Not all ASX companies. There's one company that's not listed on the ASX. Another company that's main listing is on the NASDAQ. They do have a dual listing here. And the only reason they have a dual listing here is because they bought Afterpay. So hopefully you know what company I'm talking about. But that company, Block, released their third quarter results after trading had finished for the day in America. And based off the aftermarket activity in Block, it was good results. So we'll have a look to see how the Square shares or Block Squares traded on the ASX today. Before we have a look at the companies, so 25 companies, I'm just going to quickly go through my developing investing checklist. And I hope to have this finished by the 1st of January. And I want to really adhere to this. Now, I'll probably do a standalone video on this. The main reason I'm doing this investing checklist, I do have 3 portfolios. I'm going to have a checklist for each portfolio. The main reason behind this is because I looked at my investing history since I started investing. And there is one type of company that I've not done well investing. And in fact, if I stayed cleared of that group of companies, my investing history would be much better. My returns would be much better. So my returns are okay. We're talking about, I think it was 14.8% per year, something like that. And my returns would have been much better if I did not invest in non-profitable companies. And I was amazed to see that even though I have invested and done well in some non-profitable companies, the majority of non-profitable companies I have invested in have not done that well. So I went back through my history and I took away all those non-profitable company trades, and I would have done better. So that's the motivation for me doing this investing checklist. And these checklists I wanted to adhere to whenever I make an investment, no matter what type of company it is. So I'll go through this investing checklist, which is not completed yet. I'm going through it, doing research, that sort of thing. And hopefully I'll have this completed by the 1st of January. And I've started to adhere to this investing checklist. And one of the reasons why I did sell two of these companies today was because both the companies did not fall within these investing checklists, and it was time to sell. Anyway, so I'll talk about that in another video. But first, not first, now to the main crux of the video, and this is focusing on companies that released interesting announcements through the week. And I'm going to say the winner for the week was a company I'd never heard of before, TG Minerals. Is it TG? No, TG Metals. T code TG6. Look at this incredible chart. What a chart. An amazing chart. Share price of TG6 on Monday increased 252%. I was thinking of doing a standalone video just because of this particular day, 252% in one day. You don't often see that sort of share price increase. And of course, the share price has been volatile since then, down 11% on the Tuesday, up 46% on Wednesday, down 11.5% on Thursday, and looks like up 16.5% on the Friday, finishing at 50 cents. The day before they released this announcement on Monday, the share price was 10 cents. So it's on about a five-bagger in 5 trading days. So TG Metals, what does this company do? Yes. Will I talk about Bravura in this video? I think I will. TG6. So if you never heard of this company, just have a guess what this company does. I'll give you one guess because you should only have one guess what this company does. And it's lithium. Even though lithium prices have fallen significantly, there's still a lot of excitement in the market around lithium companies. And this company on the 30th of October released an announcement, high-grade lithium intercepted at Lake Johnston. They also released an investor presentation 2 days later. And to be honest with you, I will go through this, and I'm not an expert in reading these drill thingies results, but the market liked it. I'm pretty sure Lake Johnston is in Australia. Here it is. Yeah, it's in West Australia. So obviously the market liked this. So these are good results. So maybe in the future, what you could do is have a look at these results, what caused excitement in the market, and then future results from other companies. You can compare those results to these results. They won't be similar or absolutely the same, but maybe you can compare and just see what is good results or lithium drilling results. So 9 meters at 1.35% from 30 meters, 9 meters at 1.62%. I do have a better understanding of gold or reading gold results, copper results, but definitely not lithium results. But anyway, the main reason I think the share price increased by 250% in one day is because it's a lithium company. And not only do we see excitement from maybe geologists, that sort of thing, also day traders love these sort of companies, and they love this sort of volatility in the share price. If you have a look at the 5-minute chart, something I do look at all these companies, share price is still an uptrend. Viewed a nice little dip. By the dip, possibly late on Thursday, you could have bought about 41 cents and made a nice little 20% if you bought and then sold on close today. It's concerning, maybe a little bit concerning, that the peak in the share price occurred on Thursday in the first hour of trading, and share price got to 54 cents, and the share price has struggled to get above that. So there is potential that maybe the froth is coming out of TG Metals. But who knows? This could be the next big thing when it comes to lithium. Now onto Dicker Data. Dicker Data, so a company I have put into my short-term portfolio. I've had this for a few weeks now. And this company released a market update. So this is a type of announcement I'm always looking for. Market updates, trading updates, profit upgrades, profit downgrades. So they released a market update on 31st of October. It was good, and the market liked it. And I enjoyed that the market liked it because I do have this in my trading portfolio, and it would have been awful if it was a bad trading update and the share price fell 10%. So total gross revenues up 8% to $2.4 billion. This is for the first 9 months of the year. So this company's financial year is the same as a calendar year. And EBITDA up 18.5% to $109 million. And profit after tax, or before tax, up 10.4%. The very fact that revenue is only up 8%, but EBITDA and net operating profit before tax up by more than revenue means their gross margins, or their margins, increase through the year. In fact, I do mention here year-to-date gross margins, or gross profit margin, follows at 9.6%, benefiting from improved profit margins in New Zealand. Now, I did have a look at Dicker Data. In fact, I might have it here. Yeah, here it is, Dicker Data. So this is their gross margin since 2011. Now, this is via Guru Focus. Now, so back in 2011, it had gross margins 6.9%, and gross margins did increase up to above 9% in 2015. And they've remained between about 9 and 10% since 2015. I'd probably ignore trailing 12 months and the last 6 months in Dicker Data. These are wrong numbers. So sometimes you do have to fact check some of these numbers. I did fact check the last 6 months. They split up to annual and semi-annual, and they do have the gross margins in the last half year as 13.7%. And then I went back to Dicker Data's last results. And in fact, I'll do it now. I'll show you what I did. This is fairly simple. You could have just looked at the report, but I just wanted to see if they mentioned gross margins for this half year. And of course, it's going to take ages to open up. And they did have a gross margin section somewhere here. Of course, I'm not going to be able to find it. It's going to take ages to find now. This is it. This is it. Okay, so they actually do have a gross margins for 6-month periods going back to the first half of financial year 20. And each of these gross margins they've shown here was actually the same as Guru Focus until the last half year. For some reason, Dicker Data has the gross margins for this company at 13.7%. But if you look at the presentation here, gross margins for the half year, or Dicker's half year, was only 9.4%. So I'm not sure why Guru Focus had a wrong number. I've looked at and compared the gross margins in Guru Focus to these other gross margins in the Dicker Data presentation, and they're all the same. So for some reason, there was a mistake in the last half year in Guru's Focus, Dicker Data's numbers. Anyway, I'm boring you already. So let's have a look at, let's have a look at the chart. So this is the Dicker Data chart. This is a beautiful chart. And the main reason I bought in is because when this company released their half-year results back in August, there was a nice little rally in the share price. Share price then went sideways. You can see going sideways over more than a month period. So I had a lot of time to take a position in this company, and the share price is going higher. And the last time the share price was this high was way back in February of this year. So we are talking about a 6-month high. Not only that, if the share price gets above $11.20, we are talking about a 1-year high, because the last time the share price was this high was in a down, when the share price was in a downtrend. So it does look like the sentiment in this company has shifted from negative to positive, and it looks like the trend in the share price has moved from a downtrend into an uptrend. I think we can confirm that now with Dicker Data. Ooh, it's a bit of light, bit of thunder. I was going to say I heard some lightning, but you don't hear lightning, you hear thunder. I am a meteorologist. Inghams, first half trading update. Yeah, this was good. There's no ifs or buts or whatever. This was a good update from Inghams. If you don't know what Inghams does, then you probably should go to a supermarket. Look at the chicken section and see all the Inghams chicken products. This was good. Continued improvement in operational performance, strong demand for poultry, with some customers allocating more shelf space to the category, further improvements in wholesale pricing, accelerated recovery in New Zealand. So all these bullet points they've said in the start of this particular trading update, all positive. So this was a positive update from Inghams, and it is the second positive update from the company, because it wasn't long ago. Well, it was probably the half-year results or full-year results. So this is actually fairly similar to Dicker Data. So really good results in August. Share price increased in a couple of days. Share price then went sideways for a while, and now the share price has taken off again. But unlike Dicker Data, the last time share price was this high for Inghams was way back. Ooh, look at that. Way back in October 2021. We're talking about 2-year high for Inghams Chicken or Inghams Group. Look at the weekly chart. Not sure if you can hear the thunder. That was nice and thunder. Great forecasting from the Weather Bureau. They had partly cloudy on the forecast today, and they changed it to possible shower. Yes, I am critical of public weather for the Bureau of Meteorology. Their forecasts have gone to crap. I am not in public weather, by the way. Anyway, so this is the weekly chart for Inghams, and yeah, it looks pretty good. Looks nice. I did notice this nice little rally in the share price on the release of the full year results, and I just didn't take notice of it. So maybe I shouldn't have ignored Inghams Group back then. Rectifier, a company I actually do own, and we saw a lot of weakness in the share price. And I was wondering, why is there weakness in the share price? Share price pulled to the long-term uptrend. If you look at the weekly chart, you can see the share price in this long-term uptrend. When the share price gets to this trend, the share price, that's sort of the low. And the share price has fallen through that long-term uptrend. I was wondering why there was a lot of weakness in this company's share price. No announcements from the company. And then I noticed this particular AFR article, Tritium asked Queensland government for up to $90 million bailout. This is a fast-charging company based out of Brisbane. For some reason, they decided to list on the NASDAQ. Maybe they should have listed on the ASX. They do mention here somewhere, for some reason this article is free. So revenue of $185 million for financial year 23, double financial year 22. So this company is growing significantly, but it looks like this is a typical growth company in America where they're growing revenue like nothing else, but they're not profitable. It's sort of an epidemic on for companies in America. And they do mention here somewhere, yeah, they are listed on the NASDAQ. I'm pretty sure they are. Oh, here we are. So listed on the NASDAQ in 2021 with a double unicorn $2 billion valuation, but now has a market cap of $38 million US. And they're having difficulty finding capital, and they've asked the government to give them some money. And looks like the government is unlikely to say yes. So the reason why this is related to Rectifier is because Rectifier gives them parts or something like that. I could be mistaken about that, but that's why I think there's a little bit of weakness in the share price for Rectifier. This is a profitable company, nice growth in the past year. And this is sort of in the right sector as well, but I mean, this could be just short-term headwinds for the company, and possibly the market is overreacting, and this could be a good time to take a position in the company. Not a big market cap, only $50 million or so. Ora Banda Mining, recent new gold-producing company, I believe. Well, maybe not new. But anyway, there's been a little bit of interest in this company. Share price did move into an uptrend in late 2022. There's a little bit of a pullback and a little bit of excitement during the week for Ora Banda OBM. Is it OBM? Yes. And they did release a couple of announcements during the week. On Monday, OBM signs transformational $26 million lithium joint venture with Westcaf. Again, lithium. And then on the 2nd of November, which is the Thursday, Sandkin exploration results show underground potential. But it was that 30th of October, the lithium announcement that did cause a little bit of interest. Share price rallied 18.5% on that day. So obviously, just because they have the word lithium there, the market gets a little bit excited. You can see the share price rally back up to the recent lows or recent highs we saw back in May of this year. So obviously, share price needs to get above around about 16.5 cents. So share price is struggling to get above that. As we have seen, share price now 16 cents. So definitely one to put on your watch list. Based off my investing checklist, I would not have this company on my watch list. Or I should say I would not be buying shares in this company because they are not operating cash flow positive and not profitable. But just because I have an investing checklist and this would not satisfy my investing checklist doesn't mean it shouldn't satisfy your own investing checklist. The whole point of me doing this channel is to share ideas with you, and possibly Ora Banda Mining is an idea if you like lithium, if you like gold. So a gold lithium company. Now to a company called Civmec Limited. This is a nice looking chart. Look at that chart. Share price has moved, is in an uptrend, has increased from, we'll say 60 cents to $1 over the last 7 or 8 months. And this company released a trading update. I'm pretty sure the market cap of this company is not that $450 million. So $450 million market cap. And, well, it's not Inghams, it's the wrong one. And let's have a look at this trading update. So first quarter, financial year 24 update. also had an AGM, and this was a pretty good update. I think this was a good update. So this is a quarter, EBITDA of 28.9 million, nice increase in revenue, 9.1% increase in EBITDA, profit of 15.2 million. This is one quarter, remember. So one quarter profit of 15.2 million. So if they replicate this quarter profit, the P/E ratio of this company is about 8. Now, you probably should not say if they can replicate this, or if you analyze this first quarter profit, the P/E ratio of this company is less than 10. Earnings per share, 3 cents. Strong cash flow generation from operations of 40.1 million, with a net cash position of 43.9. That is the thing that really drew me in. A really nice increase in cash generated from operations. Now, there could be a few reasons behind that, changes in working capital, that sort of thing. But nice quarter from Civmec. Not much a reaction from the market, but the share price is still in an uptrend. So, yeah, a nice chart from Civmec. And to be fair with you, I have not looked much at this company at all. I would not even know what they do. Some sort of mining services, obviously. It says investment holding company, which engages in the provision of engineering services for the oil and gas industry. So engineering services. Now to another company that I don't really follow all that closely, but Ashley Services Group, something to do with education. Is it education or recruitment? I'm having a feeling it's recruitment or employment. I can double check in a second. Established almost half a century ago as a labour hire business. Yeah, so that's how, shows you how closely I follow this company. But anyway, this was a bad announcement because contract loss. Now, this was one of their subsidiaries, and the total contract, and this was a major contract, it seems like, for them, for one of their subsidiaries. And Link, which is a subsidiary, contributed $1.1 million in net profit after tax. So they purchased 75% interest in this subsidiary in July 2022 for $4.2 million. So it'd be interesting to see. I'm pretty sure it does mention here. It says a major customer. So I just don't like the words major customer. So how big or how significant is this loss of this particular contract? Does it mention here how much? Not even sure it does mention anything about the loss or the value of the loss of the contract. But anyway, market didn't like it. Look at that. Now, what's funny, and this is the weekly chart. So if we look at the daily chart, so the share, if you go back to the weekly first, so the share price was in an uptrend. And then the share price went sideways for a period of time. And then the share price has just fallen off a cliff the last about 3 or 4 months. And it really started, the downtrend started when the company released their results in August. Share price fell 2.9% on the 30th, and then a further 8.3% on the 31st of August. That was a time to sell. That was a negative reaction from the market, and the share price has continued to fall. So you could have sold around about 65 cents, and now the share price is 39 cents. So share price fell on the 1st of November. So share price has fallen 8%, 8.7% on the 31st, and then a further 20.2% on the 1st of November. When did they release this? 31st of December. So the major reaction from this particular announcement was actually the next day, the following day, on the 1st of November. That's an interesting reaction from the market. And the biggest volume was the previous day. And then even though there was lower volume on the Wednesday, share price actually fell 20%. So maybe capitulation for Ashley Services. Company's market cap, only 54 million. Price to earning ratio 5.4, dividend of 16%. Maybe value if this contract loss for one of the subsidiaries is not that substantial. I don't know. Haven't had a look at it. And now onto a company called Phoslock. In fact, we're going to have a look at the chart first for this company. And let's have a look at the weekly chart. There was a little bit of excitement in this company prior to COVID-19. Share price of Phoslock got up to $1.60. Look at that massive increase in share price. Share price went from about 40 cents to $1.60 in about 3 months. So 4-bagger over a short period of time. And they were releasing some interesting or really good, maybe not really good, but some, yeah, we'll say good financial reports. So this company had something to do with water, improving the water quality in bodies of water. And they seemed like they were focused in China. And then there was some shenanigans in regards to their Chinese part of the business. And that's why the share price fell like this. And in fact, shares weren't traded for a long period of time. So shares in this company weren't traded for about 2 years. From the 14th of September 2020 to the 12th of September 2022, shares weren't traded. And why am I talking about Phoslock? Let's have a look at their quarterly report. Potential asset sale and wind up. Fourth quarter quarterly, or 4C quarterly, third quarter of 2023. Wind up. Well, obviously, management have just given up. Yeah, that's what it seems like. Management have given up. Phoslock Environmental Technologies today announced that directors have resolved to proceed with the proposed asset sale and to seek a delisting from the ASX and a winding up of the company. The resolution follows a comprehensive but ultimately unsuccessful process to identify options to secure the necessary capital to continue the operation of the business or the company. So obviously, maybe the next step was administration, that sort of thing. And the directors have said, well, we just give up. We're just going to sell our assets and be done with it. So anyway, so share price fallen from $1.60 to a current share price of $2.5 cents. So hopefully no shareholders are watching this video because that's a horrible, disastrous fall in the share price. Magnis Technologies. I don't follow this company all that much, but some really interesting things happened during the week. So shares of this company were suspended from trading. Go back 3 months. Suspension from quotation, something to do with the 4-year statutory accounts. And then on the 3rd of October, continuation of suspension from quotation. And the reason behind this was interesting. So the reason why they were suspended was, says here, because M&S did not lodge its 4-year statutory accounts by the due date. And then Magnis did release the results. You can see they released them at 10:08. So releasing them late is not a good thing. And then they did release them. And then the ASX said, well, we don't like, or they have concerns regarding the qualified audit opinion disclosed in the 4-year statutory accounts, which is concerning. And then the company was suspended for trading for about a month. They released 4-year statutory accounts. They also released somewhere here response to ASX query letter. Now, I am not going to go through all this because a lot of you'd have to understand the business a little bit more than I do. I did try to go through it, but a lot of shenanigans seems like it's happening with this company. But how did the market react? This is probably the most interesting thing when it comes to Magnis. So this whole thing that's been happening with this company seems like it's ho-hum. On the day when they started trading again, the share price actually did drop 19%. So you'd be thinking, oh, that's pretty negative. But the next 3 days, shares in this company went up 10%, 10.6%, and then 8.2%. And not only that, the share price is now above where it was when it was suspended. So it seems like, here it is, the 1-hour trading. So the negative reaction to this company being in suspended trading and then coming out, and the ASX was concerned about the audited, something about the audits. The negative reaction to that only lasted 2 hours. Share price, well, we'll say 3 or 4 hours. Share price went to a low in the afternoon on Tuesday. Share price went to 56 cents. Now the share price is 79 cents. So the share price has almost increased 45%. So it seems like there was a little bit of no reaction from the market. Now, in saying that, if you go back to August, late August, you can see this another rally in the share price. So another rally in the share price, and that failed. And where did that fail? In this the longer term moving average ribbon here. And where the share price is now for Magnis, right in this longer term moving average. So maybe this is the end to Magnis rally in the share price. So it remains to be seen. If you look at the daily chart, it's in a downtrend, no end in sight. Share price has fallen a lot. And again, this is not a company I would be investing in because it has no revenue. It's near revenue, I think, but not revenue yet. Now on to Dominos Pizza. Can you hear that? Thunder. Whoa. What if they've updated their forecast? I'm going to see if they've updated the forecast. Let's have a look if the bomb has updated the forecast. Just using my phone. Shower to, oh, good for them. Shower to possible storm. Went from partly cloudy to possible shower to possible storm. Back about 3 or 4 years ago, before the Bureau went through this restructuring and why public weather forecasts now are really bad or below the quality we are used to, is back in the day, we used to put time and effort into our forecasts. So at the start of today, our forecast would have read shower to possible storm. I can almost guarantee you that. So things have changed in the Bureau, management have changed, and they no longer care about the day-to-day weather forecasts. It's pretty sad. So Domino's Pizza had their AGM during the week, and not only did they have the AGM, they also gave out a trading update. And I think this was actually a pretty good trading update from Domino's Pizza. So financial year 24 update, net sales, network sales up 12.7%, same-store sales up 2.7%. I try to focus on same-store sales or like-for-like sales because Domino's have opened up some few stores. Same-store sales by region, Australia and New Zealand up 7%, Europe up 3.8%, Asia, which has struggled for Domino's, down 6.8%. So pretty good a trading update from the company. So things have turned around, in my opinion. But when you look at the chart, nothing much going on. Share price consolidating, going sideways. And I think the share price of Domino's is ready to break out after being in a downtrend for 2 years. In fact, the share price, moved into a downtrend towards October, November of 2021. So possibly things are turning around, although it did look like things were turning around in January of this year. You can see the share price trying to move in an uptrend. We saw the short-term moving averages move into the longer term. That was possible shifting in sentiment, but then that possible shifting in sentiment was blown away when the company released their financial results in February. Share price dropped 23.8%. But possibly this is a better sign. Share price consolidating. I think I am a shareholder of this company. And if I see the share price start to move upwards, I might take a trading position in this company. The next company I want to talk about is Chrysos. I should actually see how to pronounce this. So this company, I almost sold out. I'll show you when I almost sold out when we look at the chart. And the share price keeps on increasing. And So anyway, so Chrysos, Barrick Gold, and MSA Labs Global Partnership. Have a read of this. I actually missed this announcement when they released it. So even though I am a shareholder of this company, sometimes I don't look too closely at my companies. So this is a possibly pretty big partnership between Chrysos Corporation and Barrick Gold. So have a read of this. So this is interesting. That's all I'm going to say when it comes to this company. I was going to do Appendix 4C video on this company. Now, they are burning through a lot of cash because they have to build all this equipment. But I think, and the market agrees with me, there is a lot of promise in this company. So this is the chart. Beautiful uptrend. The company keeps releasing really good announcements. I nearly sold just back here in July. I don't know why I was nearly sold, but I just wanted to see what happened as the share price dipped a little bit lower. And it was really good. The share price rallied from there. Because if the share price kept on dropping, I might have sold out. If the share price dropped to, say, $4.40, I would have sold. And I dropped to $4.60. I'm just happy I did not sell. So that was a situation when I made a good decision. Good decision in hindsight. I think we should pay more attention to our good decisions and not dwell on our bad decisions. Anyway, so Chrysos Corporation, I would say this company is overvalued. $700 million market cap, but it says here price earnings ratio of 1,651. Yeah, well, I would ignore that. But I just don't know how to value this company. I'm going to be honest, I just don't know how to value this company because if I do a valuation of Chrysos, I get anything from a few billion. When I'm saying a few billion, I'm talking about $3 to $4 billion and as low as, say, 300 million. So the reason why I'm still holding this is because the best case scenario or the difference between where the company is right now to the worst case scenario is not as much as the difference between the best case scenario and where the share price is now. So the risks are not, probably the best way to say is the potential reward far outweigh the potential risk for Chrysos. That's why I still hold this company. And that's why, even though I think potentially it is overvalued, I just don't want to sell just yet. Now to a company called Domacom. Something to do with financial services. Domacom announced a strategic partnership with Superfierce. I've never heard of Superfierce. So Domacom, I've never looked at this company. So it says here, if you go to, again, if you don't know what a company does, sometimes you just go to announcement and there is an about section somewhere. So Domacom is the operator of an innovative managed investments platform for a wide range of assets across wholesale and retail markets. It doesn't really tell me exactly what they do, but then if you don't know exactly what they do, you can take a look at the website or something. Superfierce is a personal wealth platform designed to empower people with financial knowledge, tools, and services. Well, yeah. Superfierce does not offer its own financial products. So it seems like it's like a education, Superfierce, so nothing to do with superannuation, which is interesting. So this is a memorandum of understanding. Announced Domacom has entered into a non-binding memorandum of understanding, or MOU, to establish a strategic partnership with Superfierce, Australia's premier superannuation advice technology platform. So it does have something to do with superannuation. But superannuation education? I don't know. Anyway, even though there's a lot of things I don't know, even though this is not my favorite type of announcement, I don't like non-binding memorandum of understandings. I don't even like binding memorandum of understandings. The market disagrees with me. And the share price of Domacom increased, was it 100%? 27% on the first, 78.6% on the second, and the further 36% on Friday. They released this announcement on the first, which was the Wednesday, and the share price actually increased more on the Thursday. But when you look at the chart, you'll notice share price still in the downtrend. This is just a bit of a rally. Share price has increased from 1 cent a few days ago up to 3.4 cents. Not a massive volume either. So it's really interesting, not massive volume. And when you look at the what do you call this, the depth of orders, and not much on the sell side. And to be honest with you, not much on the buy side either. So I don't even think day traders are in this right now. Volume, only 286,000 shares traded today. If you look at course of sales, the first shares traded were at 11:14 a.m. Yeah, so yeah, it's just share price has increased or tripled in a very short period of time on very little volume and not as much excitement in the market. It's really interesting. Domacom, Origin Energy. I was confused by this. Okay, so this is the chart. You see a massive decrease in share price of Origin Energy on the Thursday, down 6.6%. I had a look to see why the share price was down. I heard somewhere where the potential takeover of Origin by Brookfield had fallen through. And then on the 2nd of November, the announcement was titled, Consortium increases cash consideration to $9.53 per share. That does not seem like Brookfield went bye-byes. So I was a little bit confused, and then I saw this article. Origin deal hopes crumble as Australian Super rejects sweetened bid. And that's why the share price fell, because Australian Super said, nah, get lost. We don't want this. Go away. Bye-bye. And that's why the share price has fallen back to $8.38. And this, so it looks like the first takeover bid was announced in November. And I would have sold around that time if I was a shareholder. So I would have sold about $7.90 or so. So not much of a gain loss if I sold then. That's the way I do things. When there's a takeover bid from my company, I typically sell pretty quick after that takeover bid because most takeover bids fail or fall through. Bravura. So there's been a bit of excitement in Bravura. Share price in a well-defined downtrend. This could be it for Bravura. This could be the turnaround. There's a hopeful sign after the company released their results on the 25th of August. Share price increased 44%. Share price went sideways for 2 months, and then the company had the AGM. So there must have been something good in the AGM. So share price increased 16.7%, further 6.8% on the Friday. Let's have a look at the AGM. So they did give some financial guidance. Here we go, financial year 24 guidance. Now, in their financial year 23 results, they did mention they had expectations of becoming EBITDA positive by the end of financial year 24. So by the end of financial year 24, they hope to be EBITDA positive. Now, in this financial year 24 updated guidance, they are now stating that EBITDA will be between 10 and 15 million. So it seems like what they stated in the financial year 23 results, they will be EBITDA positive in financial year 24, the whole year, not at the by the end of the year. This is why I think the market got excited. Now, revenue, no growth there, so around the same as financial year 23. But it seems like they have to maybe cut some costs, increase their margins, and now the company is moving towards being EBITDA positive. I would prefer the company be profitable and operating cash flow and free cash flow positive. But this could be the turnaround for Bravura. So, and the last time the share price was as high was back in February of this year, just before the massive drop on the 7th of March. On that day, the share price of this company dropped 54%. So it sounds like that was the last negative announcement, and maybe sentiment has shifted. This is developing a nice looking chart for Bravura. Now, what I might do is put this company onto my watch list, and if I see the share price go sideways, like we saw here from August through to October, if we see that again happen, that would be a good sign there's not a lot of selling out there. Oh, heaps more companies to go through. Now onto a company that I do own, Shopify. I was a little bit nervous about this because the share price had moved into a downtrend, and then the company released their third quarter results or something. Share price rallied 22.4%. This company has a market cap of 76.6 billion. So when the share price rallies 20%, there's something going on. Well, I've already told you, they released the third quarter results. This is investment. If someone asked me, would I prefer or compare how you get announcements on the ASX versus NASDAQ and the New York Stock Exchange, I 100% prefer getting announcements from the ASX. It's way more ordered, more simple, and maybe it's because of ComSec, but I just finding if you want to find announcements or for companies listed on the NASDAQ or New York Stock Exchange, you have to delve deeper, which is really annoying. There's no one place. I have found where you get all the announcements in the one place. That's probably the best way to say it. Unlike the ASX, where you can get all the announcements in the one place. You can't get that, or I have not yet to find that for companies listed on the NASDAQ and New York Stock Exchange. Anyway, this was a really good quarter for Shopify, and this company is turning things around. They are now profitable. So revenue up 25%, gross profit up 36% year on year, free cash flow positive for fourth consecutive quarter, reaching 16% of revenue. In fact, I remember correctly, they were free cash flow positive by about 250 to 300 million. Somewhere here. Free cash flow positive, 276 million. So right in between that. And that's the main reason the growth in this company, the very fact that they're now profitable, free cash flow positive, that sort of thing is positive. I'm not sure if they are profitable. That's the other thing. The one thing and the main thing I hate about American listed companies is the share payments. Let's see if they have share payments here. That's it. Stock-based compensation. So cash flow from operations, 718. So they did have a profit for this quarter, $718 million of profit, and only operating cash flow 278. So why was there a big difference? So there was a net gain or loss net loss on equity and other investments, but they also $102 million on stock-based compensation. I have seen some companies have stock-based compensation of over $1 billion per quarter, and that is why sometimes you see a massive difference between operating cash flow, free cash flow, and profit of the company. So a good quarter from Shopify, and my concerns about this company, just by looking at the chart, have now been alleviated. Nice increase in share price. Macquarie Bank. I really was interested to see how Macquarie Bank fared today. They released their results. Interim results, first half results. You can see share price actually was up. But when you look at the results in isolation, you might say, wow, these are horrible results. So profit down 39% on the first half of last year and down 51% on the second half. Assets under management only up 2% from 31st of March 2023, up 7% from 1 year ago. Analyzed return on equity only 8.7% compared to 16.9% in financial year 23. So all the numbers were down significantly from last year. So I thought possibly the market would overreact. And initially the market did overreact. When I say overreact, this company is going to have some good quarters or some good half years, some bad half years. One of the reasons why they had a really good year last year, or maybe one half last year, was because of the commodities part of the business. They had a really good commodities division results, and that's why they had a really good financial results. And that's even why, when you look at the PE ratio, 12.2 looks really low because of one division, really good results in one of the divisions. But anyway, when we look at the 1 hourly chart, there was a sell-off in the first hour. In fact, let's have a look at the 5-minute chart. See how long the sell-off happened. So the sell-off occurred on open. Share price was down 1.5%. And then there was a rally at 9:20 a.m., 20 minutes after shares had started trading. There was a rally in the share price and shares finished higher. So unfortunately, there's a few investors who sold out on open because the results on first looked pretty negative. But I think you have to look at the broader picture for this company. I'm not a shareholder of Macquarie Group. And when I saw these results, I went, I wonder if the market's going to react. And they sort of did. Now, it's a company I do own. And I was thinking of selling this because there was a bit of an overhang because Civmec and Apollo had some shares and they were selling their shares. And then there was an announcement today that Civmec and Apollo have sold all their holdings. Final sell down of the company. And in fact, if you look at the course of sales, you've noticed that volume was 114 million shares today. And Ventia, actually, I wonder if you can see it in this. No, you can't. Let's look at the daily chart. So you can see massive spikes in Ventia daily. So massive spikes. There was one in March, another one in May, another one in September. So this is the big sell downs. And the peak, or the bottom of the share price, was the biggest sell down. And I don't know why they sold at the bottom. So my big concern about this was just a bit of an overhang when they might sell. And when you look at the course of sales, so not much change in the share price. So I thought the share price might rally today. So you can actually see in the course of sales where this was. It was the first trades of the day. Here it is. So $2.71, they offloaded these shares, 62 million and 36.9 million shares, totaling $270 million overall. I'm pretty sure Ventia came out of Lend-Lease. I'm pretty sure. No, Civmec, not Lend-Lease, Civmec. I'm pretty sure Ventia was spun out of Civmec. And I'm actually pretty bullish on Ventia. Market cap 2.3 billion, dividend yield 8.1%, price earnings ratio 13.6. So I think there is going to be massive infrastructure spending over the next decade, 2 decades, and Ventia is one of those companies I think can really benefit from that. Onto a company called Global Data Center. So I have this company in my IPO, even though it's been listed for a while. And the reason I always refer to this is because the chart looks really good. It's one of the only IPO company or companies in my IPO watch list where the chart looks really, really good. And we saw a breakout in the share price back in April of this year, where the share price was up 12.6% on the 17th of April. That was a time to really buy into this company if you liked it. Share price since has rallied from $1.40 to $2.03. Market cap of this company, 156 million. It's pretty obvious what they do, Global Data Center Group. Anyway, this company did release, you can find it, did release a trading update today. A profit guidance. So if I see the words profit guidance, I am always going to open up. I don't think this is a profit upgrade or downgrade, but they are forecasting revenue to be between 30 and 35 million, up almost 30% from last year. Operating EBITDA between 9.8 and 10 million, up 56 to 60% from last year. I would prefer them to look at net profit and operating cash flow and free cash flow, because EBITDA, who knows, this company might have a lot of depreciation, amortization, and this company could, or maybe not profitable. But anyway, good growth in Global Data Centers Group. So Global Data Center Group aims to take advantage of the unique once-in-a-lifetime investing cycle by investing in digital infrastructure assets and businesses. Well, maybe it's a little bit different than what I thought they did. So it looks like this company invests in other companies, maybe. So maybe I have to take a closer look at a Global Data Center Group. Now on to companies that did a couple raising during the week. And we start with Paradigm. Okay, so Paradigm, biopharmaceuticals company, did a couple raising during the week. And the couple raising was priced at 43 cents. Pretty big couple raising, $30 million, $18 million institutional, $12 million one-for-one entitlement offer. Pretty sure it was at 43 cents. They will have cash of $103 million after this couple raising. And where the share price closed at? 43 cents. It was a nice discount because the share price fell 32.5%. Share price was 61.5 cents before this couple raising and closed at 43 cents. And this happens all the time when a company does a significant discount to the share price, or does a significant or capital raising at a significant discount to the share price will fall to the capital raising price or towards the capital raising price. It's no surprise. I still don't know, and some people have tried to explain it. It's all to do with the investment bankers. That's why there's so significant discounts or capital raising discounts, but it never works out. The share price always falls to the capital raising price or towards the capital raising price. Anyway, I don't even know what Paradigm Biopharmaceuticals does. Market cap is 128 million. What do they do? Well, doesn't even Trading View doesn't say what they do. I'm determined to know what they do. So let's have a look at this. About Paradigm Biopharmaceuticals, a late-stage drug development company driven by a purpose to improve. Tell me what they do. Okay, Paradigm's current focus is developing injectable pentosan polysulfate sodium, IPPS, for the treatment of diseases where inflammation plays a major pathogenic role, indicating a need for the anti-inflammatory, and tissue regenerative properties of IPPS, such as in osteoarthritis and mucopolysaccharidosis phase 2. Excuse me for mispronouncing that last word. I'm pretty sure this company is not, or does not generate any revenue. Next couple raising is Alcidion. I don't follow this company too closely anymore. I used to be a shareholder, and one of the reasons I don't follow this company too closely is, chart is awful. And I did hear someone say, who is a shareholder, why are they doing a couple raising? They have plenty of cash. So let's have a look at the Appendix 4C. Don't need to look at that anymore, or that. So let's have a look at the amount of cash this company has at the end of the quarter. Oops. $6.5 million. Now, this company did burn through a lot of cash this quarter. A lot of cash. In operations alone, this company burned through $8 million. $8 million in one order. So, and they only had $6 million of cash, which means Section 8 they had to fill out because they had less than 2 quarters of funding left. So they did answer, financial year 24 quarter 2 operating cash flow is not expected to be the same level as financial year 24, blah, blah, blah. Yeah, okay, so that's why they're undertaking capital raising, because they don't believe they have enough cash moving forward. So that shareholder was wrong. They don't have enough cash. And I'm saying share price at 7 cents, that this capital raising was done at 7 cents or near 7 cents, which would have been like a 30% discount to the share price. So let's have a look at this capital raising share purchase plan announcement. I'm saying 7 cents, maybe 7.2 cents. How much money? Only $1 million. 7.5 cents. Oh, that's actually more negative. The share price is now significantly below the capital raising price of 7.5 cents. That's actually negative. So why would you take part in this capital raising if you can buy shares on market lower than the capital raising price? Yes. I do find that if you do see the share price fall significantly below the capital raising price, that's a good indication of the sentiment of the market around the company. If the share price doesn't fall anywhere near to where the capital raising pricing is done, that means there's really positive sentiment around the capital raising, the reasons behind the capital raising, and the company itself. When you see the share price almost 10% below the capital raising price, that is a negative indication on the company itself. And 2 other companies did a capital raising. Treasury Wines, share price down 8%. Okay, so let's figure out what price this capital raising was done at. $11.04 shares closed at. I am thinking capital raising was done at a share price lower than that. I'm thinking $10.75. Let's see how right I am. And this capital raising was for an acquisition of some vineyards in Napa Valley. Paso Robles, California. I have no idea what that is. So let's have a look at this capital raising, because I have not had a look at this. So I'm saying there's probably more positive sentiment around this particular capital raising, and share price down 8.8%. So I'm saying the share price is higher than the capital raising price. And I'm saying the capital raising was done at a price of, say, maybe even $10.50. I'm saying $10.75. Let's have a look. Here we go. No, there's nothing in that. Okay. Let's have a look. Here we go. At $11.50. What? Oh, no, that's something else. At the profit price of $10.80. What's this $11.50? Total was not taken up by eligible and cleared at $11.50 per new share, which was 70 cents per new share above the offer. That's confusing to me. So I just see $10.80, which makes sense. Okay, so it's around about where I thought. Share price is still a little bit above the capital raising price. So there is a little bit of positive sentiment behind this particular capital raising, the reasons behind it, and Treasury Wine Estates also. But when you look at the chart, it's much better than Alcidion. But the share price, in fact, today, share price did get to $10.75. So share price at one point did go below the capital raising price. If I saw the share price fall to about $10.50, I actually would become interested in taking a position in this company for the long term. Because I do think they have, particularly when it comes to Penfolds, I do think this company has significant promise, potential, just with Penfolds. If they spun off Penfolds, I would buy Penfolds, possibly. And the other company that did a capital raising was Aussie Broadband. Now, this is a company I do own. And again, the capital raising was done at a discount. Was it $3.50 to $3.55, something like that. And the share price moved towards a capital raising price. Someone did ask me what I think about this capital raising and the company they're buying. I'm actually not the biggest fan of Symbio. I don't know why they're buying Symbio. Anyway, commencing at 355. Yeah, 355. So again, share price closed at 358. So why do you bother doing a capital raising at a discount where the share price is going to drop towards the capital raising? Why just not do the capital raising at 5 cents below? And when I say 5 cents, maybe 1% below the current share price. You more than likely will still get people or institutions interested in taking a position in the company or adding to their position. It's just ridiculous, in my opinion. Anyway, and I'm sort of not surprised that the share price is not that much higher than a capital raising price for Aussie Broadband, because again, Symbio, I'm not sure why there was this fight for Symbio. It's been a really horrid performer over the past 5 years. Maybe I'm being a little bit too negative on Symbio, but it's been just have a look, Symbio. I've been following this company since they were called MyNet Phone well over 10 years ago. And just have a look at the weekly chart. And not only weekly chart, look at the financials. Revenue flat. It's going nowhere. Very little profit as well. And you can just see that in the chart. Share price has done nothing since 2017. In fact, it's gone down. This is the time to own. So this company was releasing Appendix 4Cs way back in 2011, 2012. They became operating cash flow positive around 2012, and that's when the share price took off. When they became operating cash flow positive and free cash flow positive, and their receipts grew quarter on quarter, very slow, but this company became profitable, operating cash flow positive, free cash flow positive as MyNet Phone, and then it stopped in 2017. Findi. Okay. I did a standalone video on Findi yesterday, which I have not released yet. So look out for that video tomorrow. Now, it's a little bit upset because they released another announcement today, which I won't cover in my video. Our current State Bank of India contract extended to September 2024. So key highlights, blah, blah, blah. Impact of white label license. Key highlights, additional revenue of 25 to 28 million. EBITDA of 7 to 9 million. This company keeps looking more and more interesting. However, in saying that, now look at the weekly chart, look at the daily chart. Share price potentially has broken out above this nice little resistance level at 66 cents. A little bit of selling today, but really good volume coming in the last 2 weeks as the company has released a few really positive announcements. Market cap still 24 million or so. So watch out for that video on Findi that I will be releasing on Saturday, which will talk about this SBI contract, a massive contract they have signed, and then have a look at this further announcement they released on Friday. The current State Bank of India contract extended to September 2020. There was a few, sort of understand why they might have released this, because this new contract they have signed with SBI, when does that start? I did have questions about that. When does it start? Does it start another year? And looks like this current one is extended to September 2024. So I have to go through both of these announcements to see if this means this overall contract with State Bank of India is over an 11-year period. I'm not sure. I'm going to have a bit of a read of both contracts. But anyway, both positive. Neuren Pharmaceuticals, for some reason, has been on the nose on the market for some reason. I don't know why. Share price is in a downtrend. Share price up 8.5% today because Debut, Acadia, have announced that sales of Debut, which is the thing that Acadia is selling, the what's it called? Trophantide. That's it, Trophantide, for the treatment of my Rett syndrome. That's it, Rett syndrome. Can't believe anyway. So they've announced, Katie have announced sales for the third quarter and expected sales for the fourth quarter, so $66 million US, and expecting between 80 and 87.5. And down here, so they did have here the royalties to Neuren, $3.5 million in the second quarter, up to $10.4 million in the third quarter, and expected royalties of between $12.5 and $13.7 million in the fourth quarter. So analyze that. We are talking about $50 million of revenue to Neuren every year based off just the sales of debut in the fourth quarter. So that's not anticipating any growth at all. Net sales in 2023 to 170, 178 million. And I did notice when the company released their quarterly report, they have really, when you look at this, the spending, they have started to increase the spending on research and development. $6.2 million of spending. So they did receive $151 million in receipts, but $6.2 million per quarter in spending. So it looks like, I'm going to say it looks like this money they're receiving for the royalties of debut, they do have a plan to spend that in research and development to bring other products to market. That's not a bad thing, in my opinion. They have plenty of cash on hand. 135, no, that's not right. Something like $200 million of cash on hand. $230 million of cash on hand. Wow. It's the reason why I will not sell this company. I'll just maintain my holding in this company. I have taken profits, but with $230 million of cash, that gives management of this company so much flexibility in what they do. Their capital allocation decisions are insane. Now, I don't think they will give any sort of that cash back to their shareholders in terms of dividends. I don't want them to give that cash back to the shareholders as dividends. I want them, this company, to spend that money on research and development, to bring more products to market, that sort of thing. And that's how you significantly grow a company. You don't significantly grow a company by giving the cash back to your shareholders. If a company, this is how I judge a company, if a company gives or has a payout ratio, dividend payout ratio near 100%, that company is a non-growth company. That company will not grow. I want a company to grow and grow and grow. That's the best way to increase your wealth over time. Rant ended. There's Neuren. And now, the last company I'm going to look at is Square. Now, I did have a look at Block's, sorry. I did have a look at Block's quarter results. And to be honest with you, I was like, what's the market getting excited about? I don't know. I don't know. So SQ2, Block, up 25%. So you could have a look at it here. So there's no presentation, nothing like that, just a report. I had a look at it, look at the numbers, and went, okay, why is the market getting excited? So maybe the market is getting excited because the numbers are better than expected. Better than expected is what you hope for sometimes. Cash, $5 billion of cash. Equity, $32 billion of equity. Not much change there. Revenue, up a little bit. They have Bitcoin revenue, up a fair bit. But transaction-based revenue, up a little bit. So revenue growing. Operating loss, they're still loss-making. One thing here is, if I can find it somewhere, it's probably going to be in the cash flow statement. Here we go. So cash flow from operations. This company had a loss of $178.9 million in the 9 months ended September 30th. Operating cash flow positive by almost $900 million. Now, they also had share-based compensation of almost $1 billion in the 9 months. So you've got to take that into account when you're looking in operations, in my opinion, because share-based compensation is in lieu of cash. It's share-based compensation. So you have to take that into account. So that's why the company was loss-making by a fair bit, but were operating cash flow positive by almost $1 billion. That was a nice increase from last year. They were only operating cash flow positive by $130 million. Share-based compensation was $794 million. So, yeah, who knows? I don't know. I'll have a look at why the market's excited about Square or Block. Why it just could be better than expected. That's all it could be. And when you look at the chart, so let's have a look at Square 2 first. So you notice how jumpy it is, and that's because the share price of SQ2 on the ASX is almost 100% related to the share price of Block on the NASDAQ. So that's why you see these big jumps. You see this in ResMed as well, because they have a listing on the New York Stock Exchange. So you see a very similar pattern where the share price can jump a fair bit from one day to the next. So there's no, how do you say it? There's nothing, it's not like, what's a company? It's not like Treasury Wine where it's smoother. You can see it's smooth. There's no big jumps in between the days, if that makes sense. I'm not sure if I'm making sense at all. Okay, this is blocks. So this is blocks on New York Stock Exchange. And just look at that compared to this chart. So a lot of times these other companies, say Treasury Wine, the share price will decrease or increase during trading, but the main increase or decrease for SQ2 on the ASX is at the start of trading. That's when you're going to see the jump or fall in share price. It's on open, not during the trading day, if that makes sense. That's why these bodies in the candlesticks are fairly small, but if you look at the block on the New York Stock Exchange, the bodies are fairly large, much larger than SQ2. Anyway, if you look at SQ block, share price in a well-defined downtrend, nearly at a long-term low. So possible this might be the turnaround for block, or this could be just a dead cat bounce. Maybe that's all it is. Anyway, that's all I've got for this video today. I've been talking for over 1 hour and 15 minutes or so. If you have any thoughts, any questions about any company I've mentioned in today's video, leave your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.